EUR's PLN attracts traders because it appears to offer something rare in foreign exchange: movement with structure. It is not a major pair, but it does not behave like a reckless emerging market currency either. The pair sits between two worlds. On one side is the euro, backed by one of the largest currency blocks in the world. On the other side is the Polish zloty, a freely floating currency from a country that is economically tied to Europe but still retains its own monetary policy. That combination gives EUR/PLN its appeal. It can move enough to create trading opportunities, yet it often remains anchored by the economic relationship between Poland and the euro area. This is why many traders look at the pair and see something safer than USD/ZAR, USD/TRY, or other high volatility emerging market trades. The judgment is understandable, but it needs to be handled carefully because in FX, a pair can feel safe for a long time before the risk becomes visible. Poland is not an isolated economy. It is part of the European Union, deeply connected to European supply chains, strongly linked to Germany, and dependent on the broader European business cycle. This matters for EUR/PLN because the zloty is not floating in a separate universe from the euro. Poland sells into Europe, receives investment from Europe, hires and supplies labor across European networks, and remains institutionally connected to the EU framework. That gives the currency a degree of credibility that many emerging market currencies do not have. At the same time, Poland is not in the Eurozone. The zloty is still managed through Poland's own monetary policy, and that creates a separate interest rate cycle from the European Central Bank. This is the key reason EUR/PLN is tradable rather than static. If Poland had already adopted the euro, the opportunity would disappear. Since it has not, the market still has to price the difference between Polish inflation, Polish interest rates, Polish growth, Polish political risk, and the broader Eurozone backdrop. The result is a pair that often gives traders a clear macro framework. When EUR/PLN rises, the move can usually be linked to weaker sentiment toward Poland, stronger demand for the euro, lower confidence in Central and Eastern Europe, expectations of Polish rate cuts, concerns about fiscal policy, or a wider risk-off move across global markets. When EUR/PLN falls, the zloty is usually being supported by stronger Polish growth, attractive interest rate differentials, improving regional sentiment, or confidence that Poland's economy remains resilient relative to the Eurozone. This is what makes the pair feel more manageable than many other currency trades. A trader does not have to invent a story out of random price movement. The story is usually there. The difficulty is not finding a reason for the move, but deciding whether that reason is strong enough to change the regime. For a trader who prefers structure, EUR/PLN can be appealing because it often behaves like a range pair. It can move toward the top of a range when risk sentiment worsens, then drift lower when conditions normalize. It can strengthen in favor of the zloty when Polish rates remain attractive and investors are willing to hold Central European exposure. It can weaken when markets become defensive and prefer the euro over regional currencies. This kind of behavior supports a patient trading style rather than a frantic one. The strongest version of the EUR/PLN safety argument is not that the pair cannot move sharply. It can. The better argument is that EUR/PLN often moves within a framework that can be understood before the trade is taken. A trader can assess the macro environment, look at the rate differential, review inflation trends, check whether regional risk is rising, observe whether global markets are in risk-on or risk-off mode, and then decide whether the chart is offering a clean entry. That is very different from treating EUR/PLN as automatically safe. The pair should be seen as conditionally stable. Under normal market conditions, the combination of Poland's European anchor, relatively solid domestic fundamentals, and positive rate support can make zloty exposure attractive. Under stress conditions, the same pair can quickly behave like an emerging market risk trade. This distinction is where many traders get into trouble. They look at historical price behavior and assume the future will be similar. They see that EUR/PLN has often reverted after large moves and conclude that every move toward the top of a range should be sold. That logic works until it does not. A range is only useful while the market regime remains intact. Once the market begins repricing a real change in risk, fading the move becomes much more dangerous. EUR/PLN should not be traded with the assumption that every spike is temporary. The more serious question is why the spike is happening. If EUR/PLN is rising because of temporary euro strength, or a mild deterioration in sentiment, the move may create a reasonable short opportunity once momentum fades. If it is rising because investors are reassessing Poland's fiscal outlook, expecting faster Polish rate cuts, or reducing exposure to the entire region, the move may have more substance behind it. The rate differential is an important part of the trade. When Polish interest rates are higher than Eurozone rates, short EUR/PLN can be attractive because the trader is effectively long the higher yielding currency and short the lower yielding one. This can provide a carry advantage, depending on broker pricing and swap terms. The carry does not make the trade safe, but it can improve the economics of holding a short EUR's PLN position when the broader setup supports zloty strength. Carry is also one of the easiest features to misunderstand. It can make a position feel comfortable, even when the underlying risk is building. A trader may collect small positive swap while ignoring the possibility of a sudden move against the position. That is the nature of carry trades. They often reward patience during quiet periods and punish complacency during stress periods. The income can be steady, but the drawdown can arrive quickly. This is especially relevant for EUR/PLN because the zloty can be affected by global risk appetite. Poland's domestic fundamentals may be stable, but PLN can still weaken if investors are selling Central European currencies as a group. During broad risk-off conditions, markets often stop making fine distinctions between countries. They reduce exposure first and analyze the details later. When that happens, EUR/PLN can rise even if Poland has not produced any specific negative news. Geography also matters. Poland benefits from being inside the EU and NATO, but it is still located near a major geopolitical fault line. The Russia-Ukraine war changed the way investors think about the region. Markets can become accustomed to geopolitical risk for long periods, but that does not mean the risk disappears. If tension rises, PLN can become vulnerable, even when Poland's own economy remains fundamentally sound. Fiscal policy is another risk that should not be ignored. A strong growth profile can support a currency, but large deficits and rising debt can limit investor confidence. Markets do not always care about fiscal risk consistently. Sometimes they ignore it because growth is strong, or because carry is attractive. At other times, they suddenly care a great deal. This inconsistency is one reason EUR/PLN can look stable for weeks before repricing sharply. Poland's central bank also matters, because EUR/PLN is sensitive to expectations about future policy. If the market believes Polish rates will stay meaningfully above Eurozone rates, the zloty can receive support. If investors begin to expect faster rate cuts from the National Bank of Poland, the support weakens. The trade can change before the actual rate decision happens, because currency markets price expectations, not only confirmed outcomes. This is why a serious EUR/PLN strategy needs to separate normal volatility from regime change. Normal volatility can create opportunity. Regime change can destroy a range trading strategy. The difference is not always obvious in real time, but there are warning signs. Expanding volatility, repeated closes beyond prior resistance, worsening regional news, a shift in rate expectations, or a broad move against Central European currencies can all suggest that the pair is no longer behaving as a simple range trade. In a normal range environment, EUR/PLN can be traded with patience. The better entries usually come near meaningful levels, rather than in the middle of the range. Shorting EUR/PLN near the upper part of the range can make sense when PLN fundamentals remain intact, risk sentiment is stable, and the move higher looks stretched rather than justified by new information. Buying EUR/PLN near the lower part of the range can make sense when the zloty looks overextended. Polish rate support is already priced in, and the euro has a reason to recover. The middle of the range is usually where traders make poor decisions. There is often not enough reward relative to risk. The pair may look calm, but calm price action without a strong entry zone can lead to weak trades. EUR/PLN rewards selectivity more than constant activity. A trader who waits for the pair to reach clear levels will usually have a better framework than one who tries to extract money from every small fluctuation. The safest way to think about EUR/PLN is as a macro-filtered technical trade. The chart can identify the level, but the macro environment should decide whether the level deserves trust. If the pair reaches resistance during a calm market with supportive Polish fundamentals, fading the move may be reasonable. If the pair reaches the same resistance during a regional sell-off, the level may fail. The price may look similar, but the trade is not the same. Position sizing should reflect this reality. EUR/PLN may be less volatile than some high-risk emerging market pairs, but it should not be sized as though it cannot break out. A stable-looking pair can encourage traders to use larger positions, wider stops, or no stops at all. That is a mistake. The apparent stability of the pair should lead to more disciplined risk management, not less. Stops matter because the pair can gap or accelerate during events. Central bank decisions, inflation data, fiscal headlines, geopolitical developments, EU-related disputes, and global risk shocks can all change the market's view quickly. A trader who relies only on historical range behavior is exposed to the one move that does not revert quickly enough. The most professional approach is to define the invalidation point before entering the trade. If the reason for shorting EUR/PLN is that the pair is stretched within a range, then a confirmed breakout above that range should challenge the thesis. If the reason for buying EUR/PLN is that the zloty is overextended, then a continued PLN rally on improving fundamentals should challenge the thesis. A trade without invalidation is not a strategy. It is hope with leverage. EUR/PLN can be useful for traders who want slower, more structured trades. It may suit swing trading better than aggressive intraday trading, because the pair's best opportunities often come from broader macro repricing rather than minute-to-minute noise. There are intraday opportunities, but the real advantage is usually in waiting for the pair to reach important zones and then aligning the trade with the macro backdrop. For traders who like carry, EUR/PLN can also be attractive when the rate differential supports PLN and the market is not in panic mode. The problem is that carry should never be the only reason for the trade. It should be an additional benefit attached to a valid setup. If the chart is poor, the macro backdrop is deteriorating, or risk sentiment is turning against the region, carry is not enough to justify holding the position. The practical trading thesis is therefore more modest than the phrase safe pair suggests. EUR/PLN is safer than many exotic pairs because Poland has stronger institutional anchors, deeper European integration, and a more understandable macro relationship with the euro area. The pair can offer clean range opportunities when conditions are stable. It can provide carry support when Polish rates exceed eurozone rates. It can give traders enough structure to build rules rather than rely on instinct. That does not make it safe in an absolute sense. It means the risks are more identifiable. There is a major difference between a low-risk asset and a risk that appears manageable. EUR/PLN belongs in the second category. The trader still has to monitor policy expectations, fiscal credibility, geopolitical risk, regional sentiment, and global liquidity conditions. The best reason to trade EUR/PLN is not that it is calm. The best reason is that it can be understood. A trader can form a thesis, test it against the data, wait for price to reach a useful level, and define where the thesis is wrong. That is a strong foundation for a trade. It is not a guarantee of profit. The word safe should be replaced with structured. EUR/PLN is a structured pair. It has a European anchor, a domestic policy cycle, a rate differential, and a recognizable relationship with risk sentiment. Those features can make it attractive for disciplined traders. They can also make it dangerous for traders who confuse structure with protection. The pair deserves respect precisely because it looks manageable. The market does not usually punish traders for recognizing risk. It punishes them for becoming too comfortable with a risk that has been quiet for too long. EUR/PLN may be one of the cleaner FX pairs to analyze, but clean analysis is not the same as a safe trade. A serious trader can use EUR/PLN well by staying patient, avoiding the middle of the range, respecting macro filters, sizing positions conservatively, and exiting when the thesis breaks. That is the real opportunity in the pair. It is not a place to be fearless. It is a place to be precise. EUR/PLN feels safe because it has logic. The professional conclusion is that logic can improve the quality of a trade, but it cannot remove risk. The pair is attractive when the regime is stable, the level is meaningful, and the macro backdrop supports the position. When those conditions disappear, the safety thesis disappears with them.